If you are familiar with exchange-traded funds, or ETFs, you may have heard the phrase ETF arbitrage. While you know that it has something to do with ETFs, it may not be clear to you. What does ETF arbitrage really mean, and why should you care about deploying this type of strategy in your portfolio? In this short video, we will explore the concepts of ETF arbitrage using a simple analogy to find some answers. You may have heard of pair trading or buying or selling a stock spread. While it may sound like a complicated process, the mechanics are fairly simple, and the purpose, like all trading, is to make a profit. Buying a stock pair has the expectation that the stock that you buy will rise more than the stock that you sell. This is the essence of ETF arbitrage. The pair in this case is the ETF and a stock. So buying the pair or spread means that you are buying the ETF and selling the stock. Conversely, selling the pair or spread means that you are selling the ETF and buying the stock. The expectation in both cases is that you will profit on the trade, which is not determined by market direction, but rather relationship of the pair, and in this case, the ETF and the stock. Still a little confusing? Don't worry, let's take a trip to the local store and use an analogy. To start, imagine that an ETF is represented by the wine section in a grocery store. In our analogy, and depending on our mood, we could choose a red, a white, rosé, a sparkling wine, just as we could choose a sector of the market to invest in like technologies, financials, energy, etc. Now, if you take a variety of different types of wines because you're having a party and put all of them into your basket, then you've got the picture of an ETF arbitrage portfolio. A bunch of different companies individually likened to a collection of different wine varietals all bundled up together. The price of our hypothetical wine basket is the aggregate or sum of all its individual components or varieties. Further, when you buy a bottle of wine, you have to consider the brand, its quality, content, and price. This is the essence of the selection process in ETF arbitrage. To use our analogy, some wines are priced too high for their quality, so we sell those, and others are priced too low, which we buy. Returning to our real-world ETF arbitrage strategy, we are currently deploying our AI model on two ETF arbitrage trading strategies, one in the equities, or the IWM ETF, the Russell 2000 Small Cap Index, and the other in fixed income on the LQD ETF, which is investment-grade corporate bonds. For the purpose of this video, we will use the IWM ETF and discuss our equity strategy. The price of the ETF is the net asset value of all component securities in the index, in this case, the Russell 2000 Index. As you are probably aware, stock prices trade throughout the day and move up and down based on a variety of factors. The ETF index is comprised of all stocks in the Russell 2000 Index, which belong to sectors as discussed in our wine analogy. And our model identifies those securities within each of the sectors that are likely to outperform and underperform the ETF. Consequently, the model buys those stocks which are cheap and sells those stocks that are rich, while at the same time executing a hedge trade with the ETF, in this case, IWM. Simple, right? Well, sort of. What makes it more complicated is that our model considers many factors when determining the execution price, using an AI-based process, as well as deploying automation in order and execution management, risk, and exposure. While you might not need this level of sophistication when selecting your favorite bottles of wine, it certainly does come in handy when investing millions of euros in the markets. Okay, quick recap. ETF arbitrage executes trades in stock and bond instruments that are mispriced and hedges those trades with an equal value of the underlying ETF. This creates an arbitrage or a spread, which exploits mispricings while capturing the bid-ask spread of the underlying security to gain edge in the transaction. And there you have it, the story of ETF arbitrage. No multivariable equations or complex flow diagrams, just a simple metaphor about a selection of different wines. Thanks for watching and happy trading. Contact Quantiverse AI to request more information about our automated electronic trading strategies and an opportunity for investment.